Lyn Alden breaks down the Federal Reserve's monetary policy, from base money to broad money, M2.
They kind of define how many dollars there are in existence. What is a dollar? An unlevered one? It's a direct liability of the Fed, basically, either physical banknote or bank reserve. Um, and then banks, they hold dollars, either physical banknotes or bank reserves, but they're also able to lever. And so they're able to do fractional reserve banking. So they have all these deposits, and then they're backed not just by dollars, some by dollars, but then also by loans they've made, or loans that are then put into securities. So they have a combination of things that can back up the deposits in a fractional reserve system. And so M2, broadly speaking, is like all of the dollar IOUs. So for the most part, that is like all of our bank accounts. But then it also does include currency in circulation and a couple other smaller variables. Whereas when you go down the M stack toward like M0, that's base money. M1, I mostly actually disregard that because they changed the definition. So sometimes you'll see noobs online be like, look at this gigantic spike in M1, and it's like, well, it's because they changed definition. It's bad data. So I actually ignore M1, and the ones I look at are M0, which is base money, or M2, which is broad money. Skip the middle one. That's how I do it. And so those are the main differences. Broad money IOUs versus base money, kind of Fed money. Now, repos and reverse repos are interesting because what they're mechanisms to basically increase the fungibility between securities like treasuries and dollars. Because a T-bill is kind of like a dollar that pays you a yield, but it's not exactly the same as a dollar. You can't go to McDonald's and buy a burger with a T-bill. And you can't, if I want to pay Gene, it'd be tricky to find a way to send him T-bills. Right?
Yeah.
There's plenty of ways to send dollars or Bitcoin or whatever. And so, especially at the institutional level, there's these kind of gateways that make them more fungible. That basically they kind of say, look, your T-bills are kind of like dollars. And if you need dollars, you can use your T-bills to get dollars. And there's a couple ways to do that. One is in private markets. So like secured overnight financing or other types of secured lending, where an institution can say, hey, I mean, we have dollars. If you've got either T-bills or T-bonds or mortgage-backed securities, kind of these nice pools of collateral, you can deposit that with us or a counterparty we trust, and we'll give you some dollars. So we're, instead of selling your asset, which could have tax implications or other implications, you can just deposit that and we'll give you dollars until you get that back when you pass the loan back with interest. And to the extent that there's not enough private lending for that, maybe liquidity is tight. We talked about this before. There could be shortages in the system because of things that the Fed's doing or the TGA's you filling or any sort of mechanical issue. The Fed also operates a reverse repo facility and a repo facility, and they're inverse of each other. So the repo facility basically says, if you have certain types of really safe securities, you can deposit them and we will give you dollars until you pay us back and you get your collateral back. Reverse repos are the opposite. They say, you have so much cash, which is a really good problem to have, and you're not sure where to put it. And you're left to your own devices, or probably stuff it into like T-bills and drive the T-bill yield below the Fed's target. And they don't want it to be super low because they're trying to be pretty tight with monetary policy. That's why they raised the interest rate in the first place. So if T-bill rates go below their target, let's say they're round numbers, let's say they want a 4% target. They don't want T-bill yields to go down to 3.9%. That undermines their 4% short-term rate target. So they might do a thing where they say, look, here's our reverse repo facility at 4.1%. So if for whatever reason you're just swimming in cash and you would otherwise be willing to buy T-bills, stick it in our facility. So you're actually, in some ways, you're lending dollars to the Fed, not because the Fed needs dollars, but they're trying to give you something to do with those dollars. And then they will give you basically T-bills until that gets unwound. So these mechanisms, either by the private sector or when done by the Fed, are ways to increase fungibility between actual dollars, pure liquidity, and things that are close to dollars, but not quite. Either they're very close is kind of things like T-bills, and a little bit further away is, longer duration treasuries or mortgage-backed securities, kind of these broadly safe, at least in the current era, broadly safe assets that are treated as very good collateral. And so the combination of base money, levered broad money by banks, and then these facilities that can transfer them back and forth, these kind of collectively serve as the financial plumbing for the modern fiat system. And by monitoring them, it gives you signs of whether or not there's liquidity strain or not. So at the end of the quarter, when you see the Feds, when secure overnight financing rates go high, and especially when someone has to tap the Fed's facility, it kind of means that liquidity got tight. People had trouble borrowing at reasonable rates from others for cash.
Mhm.
And so the Fed had to, because their facility just can pull cash out of a void. They
Yeah.
take it.
Yeah.
They come in and say, there's a little bit of a liquidity fire. Well, we just put it out. So these are kind of things that keep the train on the track
Interesting.
up to a point. With up to unless people lose faith and inflation kind of kills it. But in terms of mechanical functioning, these things kind of keep it on the track. On the other hand, when there's plenty of reverse repos and kind of multiple entities are swimming in liquidity, there's way less likely to be one of those issues.
Yeah.
So these are just kind of ways to measure things, and these they do have some investment implications. A lot of times, unfortunately, on social media and elsewhere, you'll kind of see people talk about them. They don't know, they can sensationalize some of these metrics, draw conclusions that are not necessarily valid, but they are, to some extent, helpful to monitor in terms of just overall liquidity conditions to kind of know what's going on. And then they also, when something does happen, when something springs a leak somewhere, and people are kind of calling for the sky's falling. Looking at some of those liquidity indicators can often help you figure out what actually is the issue. And it might not be as bad, or it might be a pretty small fire to put out compared to what you'll see on social media and elsewhere.